Equity income has been a great source of income and long-term growth for investors over a very long period of time. And my colleague Mal Witten recently wrote a paper that details this and shows that historically you've got 4.5% yield before franking from the market for decades. We know this is going to be a tougher period that we're going into. The yield of the market will be 12 months ahead still in that 3.3% range before franking, another percent say for franking, which still looks pretty good against the alternative sources of income. Bond yields are going to be around less than 1. So we still think that's a really good source of income. Also, we're talking about that at a time where dividends are going up from here. We've just had 30% cuts to dividends. So the next step for that is up, whereas bond rates are going to be where they are for quite a long time. In terms of when dividends are going to get back to where they were, I think that's probably going to take 3 years. If we think about the fact that earnings will take 3 years to recover, because we're going to have a stabilisation this year, hopefully a decent run rate out of 2021 into 22, but still probably another 2 years for to claw back the profitability and margins that we've seen eroded in this last 6-month period. For dividends, I think it's interesting that what we're going to see is the next 6 months will be very uncertain, because boards are going to have to really think about whether they want to dip into the buffers that they've built up over the last few months to pay a dividend, and that will come down to what sort of line of sight they have on their future. But I think that on a 12-month view, companies are going to be pretty well positioned to return to paying dividends, because I think that those payout ratios can step up quite quickly, given that it's a really good environment for recapitalising your balance sheet. Much better than the GFC. If we think about the GFC, companies couldn't find the liquidity to recapitalise themselves, and it took a very long time for that to recover. In terms of balance sheet rebuild, debt is very available. We've seen that credit markets and banks have been happy to step back in, and the equity markets have been very quick to step in if companies need to raise equity to fix their balance sheets. So payout ratios should be able to step back up on a 12-month view. The Goldilocks stock for us as income investors are the types of stocks that are uncorrelated to the normal cycles that companies go through, and show value and yield qualities. An example of that would be the protein plays in Ingham chicken and Tassal salmon. I mean, these are companies that haven't always been a good place to get that assured income, but right now they've got strong contracts, strong management, and strong balance sheets. So we see them as really good diversifiers where we can get valuation upside and consistent yield.